This is Dr. T. Varalakshmi discussing you about the capital structure ratios as a part of business economics and financial analysis. Capital structure ratios is a sub-part of this ratio analysis or the subdivision of the ratios which are implementing for the final accounts of the every organization. So capital means every rupee spending for the business organization is called as the capital. Then this capital can be acquired by the organization in terms of the debt or in terms of the equity. So already we have discussed in this earlier videos about in the fourth unit of that one capital structure and everything. Again, so capital, if they are taken in the form of the debt, that is in the debentures, it will be called as a debt. To that debt holders, they will pay the interest. If they are getting in the form of the ownership, that is equity shares or the preference shares, then it will be called as the equity capital. And for them, the organization will pay the dividends. So that's why every organization, first they will pay the interest. Then the remaining amount is going to be sharing by the shareholders. That proportionate of the debt and equities and the solvency position of the organization is estimating with the help of this capital structure ratios. So that's why, so how much of capital is there with the organization, and in that capital, what is the debt and equity position. Assume that the organization definitely get the profits and the market fluctuality impact on the organization is less. At that time, instead of having more equity, if they get the debt capital, they can pay just a small amount of the interest rate predefined, and many profits can be enjoyed by the owner. So that in that cases, the capital structure of the organization will be most benefit. But if the organization is having more risk, market fluctuations are all occurs to that organization, at that time, it is better to go with more equity, because even if the losses comes, the equity shareholders will face that, all will share that losses. So that's why, based on this market conditions of the organizations will maintain the proportionate of the debt and equity positions of the businesses. So how well these debtors are going to be giving benefits to the organization, how well the equity holders are all getting benefit from the organization, and what is their interest coverage ratio, what is their interest coverage ratio or the dividend coverage ratio are going to be taking into the consideration. That is the capital structure. So that refers to the proportion of the each source fund of the capital to the organization. So that sources may be equity shares, preference shares, debentures, retained earnings, long-term debts, etc. So there are so many funds are all there. Out of that one, they are taking into the consideration. Then, so this capital structure is going to be depending on certain elements like business risk, operational risk, nature of the industry, management style, tax flexibility, financial flexibility. And ideal capture structure always indicates that minimize the cost of the capital, reduce the business risk, provide flexibility for that one, and provide more control over the capital structure and maximize the value of the firm. And some of the tips to the decision, because decision is evaluating of the company's need of the capital. First of all, they have to identify that one, and then they have to see the liquidity or position of the organization, and definitely later they have to develop a clear defined decision making framework based on the credit guarantee payment mechanism of the organization. So that is the overview of this capital structure ratio. This capital structure ratios is also called as the leverage ratios. There are certain various names are all using for this one, the leverage ratios. So this will subcategorized into debt to assets ratio, debt to equity ratio, financial leverage ratio, interest coverage ratio, fixed charges ratio. That is, how much of debt funds are all there out of the total assets. Let us say the organization has 1 crore worth of the assets, and out of this one, they have taken a debt of 60 lakhs. assets means 60% of the assets they have purchased by taking the debt. And to debt equity ratio, how much of debt, that is out of 10 crores worth of the capital, they have got 5 crores worth of the debt in the form of the loans and debentures, which means half of the capital is from the debt, half of the capital is on ownership basis. And financial leverage ratio, how well they are in a position to repay that debt. Are they in a good position to repay the debt or not? How much of interest they are paying? What is the burden of that interest to the organization? And the fixed charges paying to the organization. All these are all going to be calculating under the capital structure or the leverage ratios. So these are also called as solvency ratios. So solvency ratios, leverage ratios, or the capital structure ratio, which means solvency means ability of the organization to repay the debt or ability of the organization to give the returns to the investor. That is going to be analyzing with the help of this solvency ratio. Its advantages is it will identify the sustainability of the firm, and also it identifies the whether the organization gave the more benefits to the investor or not, and how well they are managing the cash relationship in the organization, and how well they are all maintaining the liquidity and long-term assets of the organization, and how well they are managing the taxable payments and the taxable income and operational incomes of the organization. Everything is going to be analyzing with the help of these solvency ratios. So if we see this capital structure ratios calculation, debt to equity ratio is going to be calculating with the help of this total liabilities divided by total equity of the organization, and equity ratios, total equity divided by total assets of the organization. Debt ratio, total liabilities divided by total assets. Easy to remember them also. So that indicates, that shows the percentage of the company's total debt and equity position, and that too how much of assets or proportion is belongs to the equity holders, and how much proportionate of the assets belongs to the debt holders. So these are all going to be calculating with the help of these capital structure ratios. So again, one by one, if we have the discussion, debt equity ratio, that indicates the out of the total capital, what is the risky funds and non-risky funds of the organization. Risky funds means compulsory organization has to pay to the debt holders. Even if the organization get the profit or the loss, they have to pay. Non-risky funds means the persons who will share the risk. If the organization get the profits, the equity shareholders will bear that one. If the organization will get the losses, the equity shareholders will also share that losses and profits. So that proportionate between the risky funds to the non-risky funds ratio is called as a debt equity ratio, that gives the ratio between the long-term debts to the equity shareholders funds. It is always based on the market conditions of the business organization. Here the benchmark of this debt equity ratio is always 1:2. 1:2. So 2:1. That is, if they have the equity, maximum debt they can go up to 2. If they have the equity of 1 rupee, they can go to the debt of maximum 2 rupees. That is their only. But beyond to that one, if they give the organization, whatever the works they have done, they have to repay to the debt only. The less profits will be enjoyed by the owner. If it is 1:1, okay, normal equivalent. It is 1:2, then we can say that the owners are all enjoying and investors are all taking more benefits. So that is depends on the market conditions of the organization. Next thing, debt assets ratio, if we take into this organization, out of this, with this capital, whether it is a debt or equity, they will purchase some assets. So in these assets, how much proportionate of the assets belongs to the debt is going to be calculating with the help of this debt assets ratio. So that range should be 0 to 1. If 0.5 indicates half of the total assets are all belongs to total debt, then the owners are having the less range. The next thing is equity assets ratio, which is also called as ROE, return on equity. That is, out of the total assets, If we less that one, if we less this debt capital, remaining balance left for the equity holders is going to be calculating with the help of return on equity basis. So here it is indicates the how well the company is benefiting to its owners or the equity shareholders, and what are the return on their equity is going to be calculating. And if number of times it is increasing, it misleads that organization is getting the benefits, but it increases the shareholders with equity will also be increases. Next thing is the financial leverage ratio. That is the total degree of the repayability position is going to be evaluating here. That is before paying the interest and tax. What are the profits of the organization out of their sales, and after paying the income tax and the interest payment, what is their benefit left with the organization is going to be calculating with the help of these financial leverages. And this gives the analysis of what before payment of the interest profit levels, after payment of this interest what is the profit levels, and its interest burden is easily identifying with the help of this interest leverage ratios, financial leverage ratios. So if we see this next thing is interest coverage ratio. Generally, the interest will be payable to the debt holders. So what is the total debt and what is the interest paying to them and what is its burden to the organization is going to be analyzing with the help of this interest coverage ratio. The less interest coverage ratio gives the more benefits to the organization. The more the interest coverage ratio will always gives the loss positions to the organization. For this one, the formula using is profits before interest and tax plus non-cash expenses which is involved in that one divided by the interest rate which is paying by the organization. To the debt holders, they will pay the interest. To the equity holders, they will pay the dividend. So that dividend burden or the cost of that dividend is going to be calculating with the help of this dividend coverage ratio. It gives the capacity of the business to repay or to share the profits of the organization. If the more the dividend coverage ratio, more trustworthy investors possibility is there by the organization and their market share value increasing can be possible. If they are paying the less dividend means they are not providing that much of a promised returns to the equity shareholders. So that is the distribution income to the equity shareholders must be very high. If they are able to reduce the interest, they can pay more dividend to the shareholders. So for this one, the formula using is net earnings divided by preference dividend or net earnings divided by equity dividend. That is going to be evaluating here. Next thing is fixed charges ratio. This is going to be evaluating the ratio between the total earnings and the fixed liability position of the organization. So generally the organization will pay fixed charges to the debt holders in the form of the interest rate, and to the preference shareholders they will pay the fixed dividends they will pay. To the equity only remaining balance will be there. For example, organization has done the sales, then they will get the income, sales revenue is there. So this sales revenue is called as the earnings before interest rate, tax rate and dividend depreciation of the organization. First they will less the depreciation from this one, that is the assets reduction value they will take into the consideration. The remaining will be called as earnings before interest and tax. Out of this one, to the debt holders, they will pay the interest rate. So if they have paid the interest rate, the remaining amount balance will be called as earnings before taxation. Then they will pay the taxation, that is earnings after tax and depreciation. But depreciation to reduce the tax and to maintain the surplus amount only they will choose, but that amount really exists with the organization. If they adds again the depreciation, that will be called as earnings after tax. After tax. If that earnings after taxations are all there, in this here is also first they will pay to the preference shareholders because limited risk is taken by the people. For your better understanding, please watch the previous videos of capital budgeting and capital structures. And previous preference shareholders, they will pay the fixed dividend. Then the remaining only called as earnings for the equity shareholders. So earnings after tax for equity shareholders. Then divided by number of the equity shareholders divide is equals the earnings per share value. Here the organization is paying fixed charges to the debt holders as well as to the preference shareholders. So that proportionate for the earning per share if they take into the consideration, that is called as the fixed charges ratio. Generally, this gives the final benefits to the owners of the organization, that is called as the fixed charges ratio. So that's about the capital structure ratios or the solvency ratios or the leverage ratios of the organization and its kinds, and each and every calculation of the every ratio, its formulas, advantages, disadvantages, and interpretation. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.